Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. Every week I do a number of videos. Each day I do a video. What I do when I'm finally finished for the week, I go back and I look through all of the different charts in my list and I pick out those ones that maybe I didn't talk about, or maybe I only talked about one or two times. And I look at those because sometimes we can get some insight by looking at those charts that may not be screaming at us right now, but we might be able to use them to get some insight or just confirm what we're already seeing. This is being prepared for Tuesday, September 5th. The markets will be closed on Monday, September 4th in observance of Labor Day. The first chart that we look at is a chart of the VIX. Now you don't see the VIX on here. It's there, but it's invisible. What I've done is I've plotted a 50-period exponential moving average on top of this. When we use the VIX, which is a fear gauge, usually when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Well, that's as it applies to static numbers, usually 12 to 12.5 on the downside and 20 or so on the upside. Well, you can see on this chart that we don't always stay within that range. The VIX is also dynamic, and during different times throughout market cycles, the VIX might have a higher range. Other times it might have a lower range. And this helps us to figure that out as to what's happening. You can see way over on the right-hand side, after the COVID plunge, and then through 2021 and into 2022, the VIX would get up to a very high reading. Well, now we're starting to drop back down. And we're wondering, is a new range being created from this? We'll only know this by watching this play out week after week. The next chart looks at the VIX and then also takes a ratio of the 3-month average of the VIX. And I mainly follow the red line here where it's continuing to go up. August was not a good month for the market. And so we've been seeing fear increase, and we're seeing this moving average start to go back up, just confirming what we're seeing in the other charts. Then sometimes the VIX doesn't really help us all that much in and of itself. So we do some different studies that apply to the VIX. The one that we look at here is the VIX to S&P 500 correlation. That's measured up here on the top. And then the correlation itself is actually down here on the bottom. And then we have the S&P below that. Sometimes when this correlation spikes up and then starts to come down, that might be giving us some kind of insight that we're not getting from the VIX itself. Right now, this is really not telling us all that much because we're not spiking up at a real extreme reading. Sometimes this is positive and sometimes it ends up being negative going forward. We also look at a thing called the skew index, where the VIX looks at the money options, the skew index looks at out of the money options. When we see a spike up into this red area, the market is expecting some kind of a big move. We're not quite sure what that move will be. Sometimes it's a bottom and we turn and start to go up. Other times it marks a top and we start to go down. Other times it just continues in the same direction that it was going in before. Right now, we're not up into this red area, so that's why I haven't been showing this chart. Then we want to see how fast is the VIX moving. We do this by plotting a 9-period RSI, and that's down below. And we're almost getting to an extreme reading as the VIX has been going down because we had a good week this past week. That means stocks are going up. Maybe we've gone down with the VIX a little too far, too fast. If we drop below this lower level, that means we'll get an extreme negative reading. We also look at the MOVE index, which measures the volatility of bonds. We look at the VIX, which measures the volatility of stocks. And then the red line down here is the S&P. And then what I've done is I've taken the VIX and subtracted the MOVE index from it to see if we get any insight from that. Nothing really telling right now. What I pay attention to is on the bottom. That's the correlation between the MOVE index and the VIX. And they're having a really strong tendency right now to go in the same direction. We also look at the VIX to MOVE ratio. When this is really going up, that means that there's typically more fear in the market. We've been dropping back down as the market has been bouncing a little bit lately. Then we look at the equity put call ratio, and this is just a daily chart. The problem with this chart is by the time I get to record each day's video, a lot of times this chart hasn't updated yet. And I have to keep going with things anyway, so I'm not able to show this chart. We take this basic information, and then we have a number of different studies that come off of that. But on a day in and day out basis, we have been seeing the equity put call ratio going down as the S&P has been going up. We look at volume. I usually show this in every video, but pretty much for the whole summer, particularly in August, we have really dropped below the average that we usually see for volume. It's picked back up a little bit later last week, but we're still well below this line. When we get above this line, that means that volume is really picking up. We want to keep an eye on where are we in comparison to the all-time high, which was set in early 2022. Right now, we're down 6.28% from that level, and I drew a line from where the high was set over to where we're at currently. Technical alerts are put out by stockcharts.com. This is free. You don't have to be a member. You don't have to pay anything to access this. They're looking at indexes, not only the S&P, but maybe the Dow or the NASDAQ or NASDAQ 100. They also look at different sectors and different markets. And when something happens, an alert is triggered, just because we like to use intermarket analysis. We not only pay attention to what's going on in the stock market, we also pay attention to what's happening in other markets. When it's green or blue, depending on how you see that, that's positive. When it's red, that's negative. And we read this from the bottom up. This is just for Friday's session, September 1st. The first thing that happened right after the open, the Dow had a bullish MACD crossover. That was a technical event that triggered this alert. Then the NASDAQ got above 14.1. Then eventually it fell down below 14,000. The communications sector, which has been one of the stronger sectors in 2023, it had a bullish percent index cross above 50. That's positive. And depending on how you look at it, oil went above 85. Now, on a personal level, that might be negative, but from a market level, since it's going higher, that is seen as positive. We also look at a number of different indexes. Everything that I do is focused around the S&P 500, but I just don't watch that in and of itself. I keep an eye on the Dow. I keep an eye on the NASDAQ 100. I keep an eye on the mid caps and the small caps. And then what I do is I look at ETFs for each of those different indexes. And Stock Charts has this ability on a score between 0 being the lowest and 100 being the highest. The higher the score, the better looking the chart is technically. Now, sometimes this is not all that helpful, and I'll try to point that out. But if you're looking to go long a particular index or a stock, you might want to look at the technical score. I don't even pay attention to something unless it's in the high 80s or early 90s. So that's where I come out with this. Coming in first place is the QQQs. This is not really all that helpful to us because the Qs, which is the NASDAQ 100, went up so strong earlier in the year. We've just been flatlining with the technical score because we're so far away from some of the moving averages that are used to compute this. But it's still looking pretty strong overall, coming in first place with a score of 98.1. In second place is the S&P 500, also kind of flatlining a little bit as the market's been gyrating around. It comes in at 88.4. In third place, and this is where we're seeing some improvement, the mid caps, which had been in last place, they've jumped up to third place now at 64.8. The diamonds, which had been in third place, have dropped a little bit, coming in at 63.1. And then in last place are the small caps, and even they're showing a lot of improvement. You can see over on the right-hand side where it's really coming up lately, coming in with a score of 51.7. Some short-term charts just to go through. This is the 20-period simple and exponential moving averages. I plot both of them on here because folks tend to use simple moving averages, but there are people that use the exponential moving average as well. We were down below that as we were declining in August. Well, now we've been able to get back above it, and we're seeing the green, actually, that's not green, that's blue. We're seeing the blue cross above the red, and so this is turning more positive in the short term. Another indicator that I created years ago, I came up with the name later on, called the boom indicator. When price is really moving either up or down, it has a tendency to get far away from the moving average, and then the moving average has a tendency to act like a magnet to drag price back to the moving average, whether it's above or below. The boom indicator tries to measure that, and we look at it with a number of different moving averages. On top is the 20-period moving average. That's why this is in the short-term section, because that's what we hit first, and we look for extreme positive or negative readings, so we can use this like an oscillator. Then we have a 50-period moving average as well as a 200-period moving average. And we're seeing a little bit of an improvement this past week as the S&P was going up, but we're not getting any extreme readings right now. We also look at a short-term rainbow going from 10 periods up to 50 periods in the moving averages, and it looks kind of cool because the colors are all different and people go, ooh, ah. we were going down and we sliced through this short-term rainbow. Now we're starting to come back up. If we can keep going up from here, these lines will start to smooth out. And in the short term anyway, we'll get more of a sustained uptrend. Or we could start falling and go below the rainbow, and then we might see more of a sustained downtrend. Then I have a moving average study based on exponential moving averages, a 20, 50, and 200. We use this often like an oscillator, looking for extreme positive or negative readings. Not really seeing all that much right now, although we are seeing some improvement as the moving averages are going up. Then we look at a 50-period moving average. We had fallen below that. We were able to recapture it, and we're moving above it. It would turn even more positive if the blue line was able to cross above the red line. Then looking at a 100-period moving average. This is what I find most helpful when the market's really treading sideways, as it did for a number of years through about 2014 to about 2016 or so, maybe a little bit before that. And usually people use the 50 and the 200. Well, this kind of is right in between those, and sometimes it can be helpful. It's still positive. We never got down to that level as we were falling in August. And the red line's still above the green line, and this is still hanging in there and looking good. Then we look at the force index, and usually I show these in the daily videos, but I haven't been doing that lately. I'm kind of changing the format to the daily videos, and I can't edit them, so I'm just blah, blah, blah all the way through, and I can't cut that stuff out. So any charts that aren't absolutely necessary, I'm not including those to try to keep the video from becoming even longer than it already is. When we're above zero and green, that's positive. When we're below zero, that's negative. What we look for is we have some Keltner bands. When we hit the upper or lower Keltner band, that means we've gone up or down too far too fast. We did decline a little bit, but this indicator is still looking positive. Then we just want to check in with the fundamentals. Up on top is the S&P 500. These are earnings, which is pretty much flattened out. Even though we're going through earnings season and kind of getting beyond that, they haven't really made it to this chart yet. As the S&P has been going up, the PE ratio also goes up. And as the S&P has been going down, the PE ratio has been turning a little bit back down. This is what we look for when we talk about the market is expensive, or it's fairly priced, or it's cheap. In inverse to that is the bottom, which is the yield. These are the dividends that you get by owning the S&P 500. As the S&P goes up, the earnings yield ends up going down. Some intermediate term charts. This is the go, no-go system, which is supposed to be a standalone trading system. I just use it for seeing what colors it's going to turn into. When we're dark blue, that's positive. Lighter blue, that's more positive but negative at the same time. And then when it's really jumping around and changing to purple and light purple and deep purple, and then we have some smoke on the water right here, this is really acting up right now. So it's not really helping us with any insight at this time, but it can be useful at times. Then we look at the Connors RSI, which is very similar to a regular RSI, except this one is really jumpy. It's really, really short term. We use it like an oscillator. Extreme positive or negative, above or below the dashed line, signifies whether we're leaning more positive or negative. Then the Erin indicator. We pretty much have been going sideways a little bit here. This is kind of a funky indicator. The red line measures the sellers. The green line measures the buyers. And when we were going down, the red line was pegged near the top. That means that sellers were in control and buyers were starting to trail off. Then, as we see a little bit of an improvement, we're seeing the green line turning back up as the red line continues to decline. What I follow the most is on the bottom. This is an oscillator, and it measures the difference between the two. When we're above zero, that's positive. Below zero, that's negative. We had dropped below zero, and we're starting to turn back up a little bit, so we might be seeing some improvement with this chart. We look at our shortest term oscillator, which is the slope oscillator. It was the first one to turn up after giving us an extreme negative reading, and it's starting to look more positive, and we're getting above the dashed line here, which is the midpoint. So things in a short-term basis anyway are looking a little better. We also keep a close eye on the MACD. This is heavily used. This is one of the first indicators that a lot of people will typically learn about. We had dropped below zero. We were starting to get extreme negatives, starting to turn back up. Now we're coming back above zero, so this is showing some improvement. Usually what I do in the daily videos, I have all of the oscillators listed as one big chart, and then if one is really doing something interesting, then I'll pull out an individual chart of that oscillator. Here's the Chaikin oscillator. It's still above the dashed line, so it's positive, but it has been declining. So a little bit of a warning sign there. The money flow index, another oscillator, crossing above 50 and advancing. That's positive. The ultimate oscillator is also kind of like the other oscillator, where it's turning back down slightly and just about at the midpoint. So this one is neutral right now. We look at on-balance volume. When we're above the red line, which is a moving average, that's more positive. We did drop below that, and then the moving average started to go back down. If we can stay above this red line, the red line itself will start to turn up, and that will be more positive. Then we look at a 200 period moving average study. That's on the top. These are all the stocks inside the S&P that are above or below their 200-day moving average. When this is going up, this shows improvement. When it's going down, that means that we're seeing some weakness. Then on the bottom, we do that same thing, but with a 50-period moving average study, and this tends to move a lot quicker. So quite often the bottom part of the chart will precede the top part of the chart. Then we look at the RSI and have a couple of different periods that we plot on there. A little bit longer term is the RSI 14. We're above 50 and going sideways, but this is showing some improvement. We're also going sideways to slightly down with the 9 period, and this one tends to move faster. Then we're not seeing anything new with the point and figure chart. We have X's and O's in here. X's mean we're going up, O's mean we're going down. You could try to design a football offensive program or something around this. But since nothing new has been generated, I haven't been showing the daily chart. I do show the weekly chart in the weekly video. Bollinger Bands. This is showing some improvement, but not giving us a real extreme reading right now. We were able to let me try that again. We were able to get back across the midpoint and get above that. So that's turning things more positive. We get a little bit concerned when we go outside the upper or lower Bollinger Band. And the next chart is what measures that. It's called the percent B. It's not giving us an extreme positive or negative reading. We're leaning more towards the positive side because we're above the midpoint and showing a little bit of improvement. Then we have an intermediate term rainbow going from 50 periods up to 100. We came down into the rainbow. Now we're starting to go back up out of it. If we can stay above it, it'll help smooth these lines out again. Look at standard deviation based on 10 periods. How far are we above or below the average price over the last 10 periods or the standard price? We've been moving up and starting to break out a little bit, even though some of our indicators are suggesting that we're not trending right now, but we're seeing some upward movement. So we've been seeing this chart go up a little bit. Then longer term, this is an oscillator. And I talk about this in every video that I do each day, but I don't always show the chart. This is called the Special K, a very long-term oscillator. Right about the time we started going negative in early 2022, this crossed over negative, and it stayed negative until we crossed back above this a little bit more with enthusiasm in beginning of summer or so. And this is looking more positive. As we saw some weakness in August, it was starting to show some weakness, but then this past week, it's starting to turn back up slightly. The problem that we're having right now is the daily chart is looking positive where the weekly chart is still negative. The Pring bottom fisher is pretty good at finding bottoms when we have a climactic type of move to the downside. We did get a signal generated back in July, but you can see we really didn't have any kind of climactic move here. And that signal quickly went away, and now it's flattening out, so it's not really telling us anything. Then we look at the Sean trend meter, which tries to measure, are we going up or down? We're seeing a lot of improvement. We came down into this yellow area. That's more neutral. We're showing some more improvement. If we go above this red line and then above the blue line, this would be an extreme positive reading. And then we look at a 50-period, we look at an anchored moving average going back to the all-time high, step back in early 2022. We're well above this moving average right now, so I haven't been showing that. And then we want to know, are we above or below the 200-day simple moving average? And when we're green, we are above that. That's positive. And then we compare the S&P 100 to the S&P 500. They're moving more or less in lockstep, even though the mega caps have been outperforming the smaller stocks. Some long-term charts. We have another rainbow going from 50 periods up to 250 periods. We did come down a bit into the rainbow, but now we're starting to go back up. We have a longer-term moving average study. I have a 50-period moving average up here, just kind of for reference. What I'm really looking at is the 150 and 200. When we're above the midpoint here, that's positive. We came right about down to that level with both of these, and now we're starting to see a little bit of an improvement here. And then we look at a weekly chart of the S&P on top, and then a weekly chart of the German DAX. That's the index in Germany. And then we try to see, because sometimes they have a really strong correlated relationship. Right now, that's not happening. It's really falling off. When we get a high level in this correlation indicator, that means they're going in the same direction, but that's not happening right now. Then we look at the 10-year yield in the US, and we subtract the German 10-year yield called the Bund. And then that gives us a line that we see on top. And sometimes it tends to follow what's happening with the US dollar index. Not always, but sometimes it does. When we get up into this blue area, that means that they are correlating with each other. Well, we're dropping back down and not really showing anything decisive right now, so I haven't been showing this chart. Some support and resistance areas. This is something that I talk about in every video. I say we're above the downtrend channel upper line. Well, this is the chart that goes with that statement. And because we're far away from this red line, that's why I haven't been showing the chart. How this was constructed is we hit a low back in June of 2022. We hit another low in October of 2022. I just drew a trend line from this low to that low. And then I went back to the all-time high and drew a parallel line coming down from here. Well, when we were going up in late spring, early summer, it looked like this may provide some significant overhead resistance. And it did. We bumped into that a few times. We were finally able to break through it. And so now we've kind of left it in the rearview mirror. If we start to come back down and we get closer to this line, then I'll start showing this chart again. Then we take a look at the COVID low and then go to the all-time high. And these are just quadrant lines. It takes this whole area and separates it up into 4 chunks, because earlier on in 2023, this was providing some pretty significant overhead resistance, even in 2022. Well, we were able to break above that, and we're still above it. So really, we're not getting any insight from this. We look at a number of different Fibonacci charts. We're above this 100% retracement now, and really in no man's land. When we were starting to go down, I was bringing up this chart a little bit because we were getting down about to this level. And if we break through this support, that could be quite negative. Then I have a longer term fib chart where we're still above the 61.8% retracement level. I did show this a few times as we were coming down, but we never quite got down to that level. And then a longer term fib chart, which has different Fibonacci levels on top of each other. I always find that fascinating. And they're measured from different lows, going pretty much to the all-time high. We're well above this green line that you see right here, and we're kind of in no man's land right now. So we're not really getting anything from this chart. Some broad market measures. We have the VIX. This is the VIX for the NASDAQ 100. I don't use the top part of this chart because you can see it looks like icicles hanging off a roof. But we have been seeing where fear has been really dropping off in this indicator. And then we look at a weekly chart of the QQQs, which is the NASDAQ 100. And then we measure going back to the all-time high, and we put an anchored moving average there. And we're still well above this moving average. So we're not really getting any insight from this. We look at the fib levels for the NASDAQ 100. I was showing this chart as we were coming down in August. We didn't quite get down to this level before we turned and started to go back up. If we start to fall, then I'll probably break out this chart again. Then we look at the 1 to 3 month T-bill, which you could call cash, and we compare it with further out bonds. And this, when I first started using this chart, was in the late spring. And that's this red area here, because I thought, wow, something really cool is happening. We're seeing this ratio going down, and that means maybe the market thinks that we're done raising interest rates. Well, that's not really how it turned out. We ended up turning and going back up with this ratio, meaning that there's uncertainty about what is the Fed going to do with interest rates? And that's why we're seeing this ratio continuing to go up. And then we have a chart that I already talked about. Okay. And then we look at the relationship between the S&P 500 and the transports. We want the transports to do quite well if you're bullish on the market. Their relationship isn't as strong as it has been in the past, but they're having a pretty good tendency to go in the same direction. Then we keep an eye on the banks, because back in March, we had those banking problems, and we're wondering if they're ever going to start creeping up again. The bank ETF is in a longer-term downtrend. We came back up to the 200-day moving average. That didn't really hold up too well, so we ended up falling down to the 50-period moving average, and so far this has kind of been acting as loose support. We look at the financial sector, which did generate a recent golden cross. That's positive. And we did that while we were really breaking out. Well, we've come back down to this 200-day moving average. That's providing support, which could be positive as we're seeing the financial sector improve slightly. And then we compare the financial sector to the S&P, where it is continuing to really underperform. We look at the regional banking ETF and compare it to the financial sector, where the regional banking ETF continues to really underperform, even though it's about trying to show some improvement. Then we're looking at a long-term chart of the financial sector, where we set a high back in 2007, and then we just started to go down, down, down. Took us a long time to get right back up to this level, right about when the whole COVID thing produced a real big plunge. Isn't that interesting? And we're seeing that on a lot of different charts. Well, with all this liquidity that was thrown into the market, we were able to see the financial sector really recover and break above this resistance level. What had been resistance now becomes support. And as we've been seeing some difficulties in the financial sector, so far this support level is holding. And right now we're kind of far away from that. So I haven't been showing this chart. And then we look at the S&P 500 on the top and the QQQs to the diamonds ratio. And really all I look at on this chart, if I can keep it up here, is that they're having a really strong tendency to go in the same direction, the NASDAQ 100 and the Dow Jones. We want to keep an eye on the Dow and the transports. The black line is the Dow, the red line is the transports. Not getting an awful lot out of this chart. We have other studies that we look at. We also keep an eye on the S&P 500 and compare it to the equal weight S&P 500. When the big mega caps are outperforming, that's when we're seeing this ratio really going up. Then we look at the cumulative new highs and new lows for the NASDAQ, and I mention this every time in the daily videos, but it's been negative for years now, and we're dropping below zero right here. So I haven't been showing this chart because I'm just like, blah, 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 saying the same thing all the time. Some rate of change charts. I have a lot of rate of change charts. I just show the longest ones. This goes back 250 periods, showing that on a longer term basis, we're seeing some improvement. This is also based on 250 periods, show that we're bouncing up, but this goes all the way back to 1980. Keeping an eye on the bond market, where we look at the relationship between the S&P 500 and the long-term bond ETF. And for quite a while, the relationship was quite strong, meaning that bonds based on price and the S&P were having a tendency to go in the same direction. Well, we started to see that fall apart a little bit in late spring, early summer. Now it's starting to improve a little bit. So we're wondering, is this going to keep going up? Then we look at a shorter term relationship here, and the higher this is, the stronger the correlation is between the S&P and the long-term bond. Down below, we have a couple of different ways of measuring the spread between the two. We keep an eye on all the different yield curves, and I mention this all the time. All the yield curves, okay, let me try to say that again. All of the yield curves that we follow remain inverted. The ones that I pay attention to the most are the 10 to the 2-year spread and the 10 to the 3-month. That's what a lot of economists end up watching. If we go back to the point where we're more normal, then that sometimes can start the countdown to say, okay, we should be heading into a recession after that. But we've been battling this for over a year now. Some of these have been inverted for even longer than that. So I'm just kind of like a broken record when I say this every day. This is looking at the bond, the 3 to 7 year bond ETF, and comparing it to the S&P 500, where it's showing that bonds continue to underperform stocks. Now I have another chart of this showing how the S&P is outperforming the shorter term bonds, suggesting that we might see a soft landing. Then we look at the value to growth ratio. That's what's measured here with the black line, where it's going down. And then we have the 10-year yield, which has been going up. And they had been seeing a pretty strong correlated relationship. I'm not quite sure, because this is going up and this is going down, and they're going in the same direction. Okay, try to figure that one out. I may need to play with this chart a little bit and come up with some different settings for this. Then we look at the QQQs to the long-term bond ETF, and they're having a slight tendency now to go in the same direction after they had been going in opposite directions. Then we look at the equal weight S&P 500, and then we have an inverted version of the MOVE index, which measures the volatility of bonds. And this is showing that there's a pretty high correlation right now. This is a newer chart, and I'm still kind of trying to figure out, okay, what useful thing can we get from this? And so the MOVE index is really kind of new and hasn't been around for longer than a few years. So I don't have a lot of historical data where I can go back and test this and try to get some insight from it. And then another thing we look at is the 3-month yield. We set a high back in 2007, and then we had the great financial crisis after that. Well, we're coming up and we actually broke out above that level. If we start to roll over and come back down, is that going to mean that we should get ready for something bad to happen? We don't know yet. We've been watching this for a number of months now, and it really hasn't rolled over yet, so we're not quite sure what will happen there. Some possible positive scenarios, and we usually look at these when the market has really been going down, 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 and we're seeing a lot of these things come together to suggest that maybe we put in a bottom. But as we're going up and down, we can still use these to get an overall feel for what is the market? Is it more positive or negative? What we look at first is growth to value. We compare the Qs, which is growth, to the S&P 500, which is growth and value. When this is going up, that means growth is outperforming. Discretionary, which also can lean more towards growth, comparing that to the S&P, where it's actually been declining a bit. And then we compare large cap growth with large cap value, and we're seeing some improvement there. Then we look at growth to value with the large cap showing some improvement. The mid caps and the small caps are actually showing some weakness. In a good, solid environment, we want to see all of these ratios going up. In a more negative environment, we'll see these ratios going down. Then we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. After dropping below zero and looking more negative, we're showing some improvement here where we're crossing back above the zero line. That means on a broad market sense, we're showing some improvement. And then we look at the stocks above their 50-day moving average for the S&P. We're a little bit above 50 now, where we had dropped below 50. So this is showing some improvement. Quite often, I'll use this like an oscillator when we get an extreme positive or negative reading. We look at the exponential moving average of the new highs minus the new lows. We're still positive, but we had been really going up with this indicator. Now we're starting to come back down as we were hitting some difficult times in August. If we are going to turn back positive, we want to see this red line turn and go back up. This is the actual indicator, which is the black line. And then I plot the red line on here, which is used on the previous chart. And this is showing some improvement. So if this continues to go up, we should see that red line start to turn up as well. Then we look at the 19-day exponential moving average of the advanced decline ratio. When this is above the zero line and advancing, that's positive. Below zero and declining, that's negative. And I didn't update this with the arrows, but we're showing some improvement, both based on price and volume. Then we look at what I just showed you was another look at the 50-day moving average study for the S&P. Then we also look at the mid caps, and just to get an idea of what's happening. And we're showing some improvement with the mid caps, and we're also seeing a bit of an improvement with the small caps. And then this is a chart that sometimes can be very helpful and sometimes it's useless. This is the 2-year treasury yield on the bottom. And sometimes when this spikes up and then comes down, that will often give some short to intermediate term support to the S&P. We spent a lot of this year with the S&P and the 2-year yield going in the same direction. So it hasn't really helped us all that much. Now, it could change at some point, and I look at this every day, but right now it's really not telling us all that much. And then we look at the stocks above their 200-day moving average. This is longer term. We use it like an oscillator when it becomes extreme positive or negative, whether it's above or below 50. And we're showing some improvement here. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you're having a really nice weekend, and I will talk to you in the next video.